You know what separates investors who survive crashes from those who get wiped out? It's not intelligence, it's not luck, it's not timing, it's the structure of their portfolio. I've been through 14 major crashes in my lifetime: the 1987 crash, the dot-com bust in 2000, the financial crisis in 2008, the COVID panic in 2020. And you know what? My wealth didn't just survive, it grew. Not because I predicted these crashes, I didn't. Nobody can. But because I owned four specific types of assets, four things that work together like a fortress, protecting each other, supporting each other, creating stability when everything else is falling apart. And here's the thing most people don't realize. These aren't complicated. They're not secrets. Anyone can build this, but most people don't. And that's why most people lose money when crashes hit. Today, I'm going to show you exactly what these four assets are, how they work together, why you need all four of them, and how to structure them so you're protected no matter what happens next. Because the next crash is coming, I can promise you that. I don't know when. Could be next year. Could be 5 years from now. But it's coming. And when it does, you'll either be protected or you'll be exposed. The choice is yours. Let me show you how to be ready. Here's something most people don't understand about crashes. They're not random disasters. They're regular occurrences. They're part of the cycle. Since I started investing in 1942, there's been a major market crash roughly every 7 years. Sometimes more frequent, sometimes less, but they always come. And here's the thing, every single crash follows the same pattern. Fear spreads, prices collapse, everyone sells, portfolios get destroyed, and then, eventually, things recover. But not everyone recovers. Some people never come back. They sold at the bottom, they panicked, they didn't have the right protection. I've never had that problem, because for over 75 years, I've maintained the same four-asset structure. It's protected me through every crash, through wars, through recessions, through panics, and it will protect you too, if you build it right. Let me start with the foundation, the bedrock of everything. Real businesses that produce real things. Now, I'm not talking about speculative stocks, not hot tips from your neighbor, not the latest tech company that's going to revolutionize the world. I'm talking about boring businesses. Businesses that make products people need every single day, that generate cash, that will still be operating 20 years from now, 50 years from now. See, during a crash, stock prices fall, everything falls. People panic, they sell. The market drops 30%, 40%, sometimes 50%. But here's what most people miss. Underneath those falling prices, the best businesses keep running. They keep serving customers. They keep generating cash. They keep creating value. The stock price is just noise. The business is what matters. Let me tell you about my railroad, BNSF. I bought it in 2010, right after the financial crisis. And you know what that railroad does? It moves goods across America. Coal, grain, consumer products, everything. During the 2008 crash, did people stop needing to move goods? No. Did the railroad tracks disappear? No. Did the business stop making money? No. The stock price fell with everything else, but the business itself, it was fine. It kept operating, kept generating billions in cash every year, and today it's worth far more than what I paid. That's what real productive businesses do. They survive crashes, they keep producing, they keep creating value because they're grounded in physical reality, not in speculation, not in hope, in actual productive capacity. Now, what makes a business truly protective during crashes? 3 things. First, it needs to produce something essential, something people need in good times and bad times. Food, energy, basic services, not luxury items, not discretionary spending, necessities. Second, it needs to have strong cash flow, real cash coming in the door every day, because cash is what lets a business survive when times get tough, when credit dries up, when customers slow down. Cash flow is survival. Third, it needs minimal debt, because debt is what kills companies during crashes. When revenues fall and you still have to make debt payments, that's when bankruptcies happen. But if you have little debt and strong cash flow, you survive. You might suffer, but you survive. I own entire businesses, utilities, insurance companies, manufacturing plants, a furniture store, a jewelry store. These aren't exciting businesses. They're boring, predictable, but that's exactly why they're protective. Now, most people can't buy entire businesses like I do, but you can buy pieces of great businesses through stocks. And if you choose the right ones, businesses with these characteristics, you'll have protection. Companies like Coca-Cola, people drink soda in recessions. Johnson & Johnson, people need medical products in recessions. Procter & Gamble, people buy soap and toothpaste in recessions. These businesses, they're your foundation, your bedrock, and if you own a portfolio of them, if you own 5 or 10 truly great businesses, you'll survive every crash, because underneath the falling stock prices, the businesses keep working. Now let me tell you about the second asset, the stabilizer, bonds. I know bonds aren't exciting, they don't get talked about at cocktail parties, nobody brags about their bond returns, but during crashes, bonds are your best friend. Here's what most people don't realize. When stocks crash, bonds usually go up, or at least they don't fall nearly as much. Why? Because in a panic, investors flee to safety, and safety means government bonds. So when your stocks are down 30%, your bonds might be up 10%. That cushions the blow. It reduces your overall loss. It keeps you from panicking and selling everything. Let me show you what this looked like in 2008. From October 2007 to March 2009, the stock market fell 57%. 57%. If you had $100,000 in stocks, it became $43,000. But if you had $70,000 in stocks and $30,000 in treasury bonds, you didn't lose 57%. You lost maybe 35%. Because while your stocks were getting destroyed, your bonds were holding steady or even gaining value. That difference, that 22% less loss, that's enormous. It's the difference between panic and calm, between selling at the bottom and holding through, between financial destruction and financial survival. Now, I don't personally hold a lot of bonds at Berkshire. We have other ways to create stability, but for most individual investors, bonds are essential, especially as you get older, especially as you get closer to needing the money. But here's the critical part. Not all bonds are the same. There are safe bonds and there are dangerous bonds. Safe bonds are U.S. Treasury bonds, government-backed, zero default risk. These are what you want for protection. Dangerous bonds are corporate bonds from risky companies. Junk bonds. These can lose just as much as stocks during a crash, and if they do, what's the point? The whole reason you own bonds is for safety, for stability. If they're not providing that, you're wasting your money. So stick with treasuries. Maybe some highly rated corporate bonds from rock-solid companies, but nothing speculative, nothing risky. How much should you have in bonds? That depends on your age and situation. But here's a rough guide. Take your age and subtract 20. That's your bond percentage. If you're 40, maybe 20% bonds. If you're 60, maybe 40% bonds. If you're 70, maybe 50% bonds. The key is as you get older, you shift more into bonds because you have less time to recover from crashes. You need more stability, more certainty. Young people can afford to take risks. They have 30 or 40 years for their portfolios to recover. But if you're 65 and the market crashes 50%, you might never recover. That's why bonds matter more as you age. Now let me tell you about the third asset. This one's subtle but powerful. Businesses with what I call moats, competitive advantages so strong that nothing can penetrate them. See, not all businesses are created equal. Some businesses are in competitive industries where anyone can come in and steal their customers. These businesses struggle during crashes. Their profits disappear. Sometimes they fail completely. But other businesses have moats. Barriers that protect them, brand power, network effects, patents, switching costs, something that makes them almost impossible to compete with. These businesses don't just survive crashes, they often get stronger because their weaker competitors fail, and when the economy recovers, they have more market share than before. Let me tell you about American Express. I've owned it since the 1960s, and it has one of the widest moats I've ever seen. Why? Because American Express isn't just a credit card, it's a status symbol, it's a relationship. People who use Amex, they're loyal. They don't switch to another card because it has slightly better rewards. The brand means something to them. And merchants, they pay higher fees to accept Amex because Amex customers spend more. They're affluent, they're valuable. So American Express has this two-sided network. Cardholders love it, merchants want it, and that creates a moat, a competitive advantage that's almost impossible to break. During the 2008 crash, did Amex suffer? Yes, people spent less. Defaults went up, the stock crashed with everything else, but the business survived, the moat held. And when things recovered, Amex was stronger than ever. That's what moats do. They protect businesses during tough times. They ensure survival. And survival is what matters most during crashes. Now, how do you identify businesses with moats? Look for a few things. First, pricing power. Can the business raise prices without losing customers? If yes, it has a moat. If no, it's in a commodity business. Second, customer retention. Do customers stay with the business year after year, or do they constantly shop around? High retention means a moat. Low retention means competition. Third, return on invested capital. Does the business generate high returns on the capital it invests? If yes, it has a competitive advantage. If no, it's probably struggling in a competitive market. When I look at businesses like Apple, Coca-Cola, Visa, MasterCard, I see moats. Powerful brands, network effects, switching costs. These businesses aren't going anywhere. They'll survive every crash. They'll be here 20 years from now, probably 50 years from now. And if you own a collection of these businesses, you have protection. Because even in the worst crashes, these companies keep operating, keep generating profits, keep building value. Now let me tell you about the fourth asset, the most important one, cash. I know what you're thinking. Warren, cash doesn't grow. Cash loses value to inflation. Why would I hold cash? Because cash isn't an investment, it's ammunition. See, during every crash, incredible opportunities appear. Great businesses go on sale. You can buy $1 of value for 50 cents, but only if you have cash to deploy. If you're fully invested, if every dollar is tied up in stocks, you can't do anything. You just watch these opportunities pass by. You can't act. But if you have cash, if you've been patient and kept dry powder on the sidelines, you can move. You can buy when everyone else is selling. You can be greedy when others are fearful. That's how I made billions in 2008. Not by being smart, not by predicting the crash, by having cash when the crash happened. In September 2008, Lehman Brothers failed. Goldman Sachs was next. They desperately needed capital. They came to me, and I had $40 billion in cash sitting at Berkshire waiting for exactly this kind of opportunity. So I invested $5 billion in Goldman at terms that were incredibly favorable, a 10% dividend, plus warrants to buy stock cheap. It was the deal of a lifetime. Why? Because I had cash when they needed it. If I'd been fully invested, I couldn't have made that deal. But because I'd maintained cash reserves, because I'd been patient while everyone else was putting every dollar to work, I could act. That Goldman investment made Berkshire $3.7 billion in just 3 years. And I made similar deals with General Electric, Bank of America, Mars, Dow Chemical, billions in profits, all because I had cash. Now, how much cash should you keep? That depends on a lot of factors. Your age, your risk tolerance, market conditions. But here's my rule. Always keep at least 6 months of living expenses in cash. That's your emergency fund, your safety net. Never touch it. Beyond that, keep investment cash, money you can deploy when opportunities arise. How much? I'd say 10% to 30% of your investable assets, depending on market conditions. When markets are expensive, when everything's going up and people are euphoric, keep more cash. Maybe 30%. Be patient. Wait. When markets are cheap, when there's fear and panic, keep less cash. Maybe 10%. Because that's when you should be deploying it. The key is never be fully invested. Always have some cash. Because the opportunities, they always come. But only if you're ready. You see, most investors have this backwards. When the market's going up, they get excited and they invest everything. Then when the crash comes and opportunities appear, they have no cash. They can't act. But smart investors, they keep cash during the boom. They're patient. They wait. And when the crash comes, they're ready. They have ammunition. That's the difference between making money during crashes and losing money. It's not about being smart. It's about being prepared. So those are the four assets: real productive businesses, safe liquid bonds, businesses with moats, and cash for opportunities. Now, here's what's critical. You need all four, not just one or two, all four, because they work together, they balance each other, they create a portfolio that can survive anything. The real businesses give you a foundation. They keep operating, keep generating value, even when stock prices are falling. The bonds give you stability. They cushion the blow when stocks crash. They keep your losses manageable. The moat businesses give you long-term protection. They survive. They endure. They come back stronger after every crash. And the cash gives you flexibility, the ability to act when others can't, to buy when fear is highest, to turn crashes into opportunities. Together, these four assets create a fortress, a structure that's protected my wealth through 14 major crashes, and it will protect yours too. Let me show you how this works in practice. Say you have $500,000 to invest. Here's how you might structure it. $200,000 in real productive businesses, maybe some index funds, maybe some individual stocks in companies that make essential products, companies with strong cash flow and little debt, $100,000 in bonds, treasury bonds mostly, maybe some highly rated corporate bonds, nothing risky, just stability, $150,000 in businesses with moats, companies like Coca-Cola, American Express, Visa, businesses with competitive advantages so strong they'll survive anything, and $50,000 in cash, sitting there, waiting, ready to deploy when opportunities arise. Now, when a crash comes, and it will come, what happens? Your stocks fall, maybe 40%. So your $350,000 in stocks becomes $210,000. You've lost $140,000. But your bonds, they're up maybe 10%. So your $100,000 becomes $110,000. You've gained $10,000. And your cash, it's still cash, still $50,000, ready to deploy. So your total portfolio went from $500,000 to $370,000. You lost $130,000. That's 26%. But the market fell 40%. You only fell 26%. You did 14% better than the market because you had protection, because you had structure. And more importantly, you have $50,000 in cash to buy stocks at 40% off, to turn this crash into an opportunity. That's the power of having all four assets. That's how you survive crashes. Now let me talk about something just as important as the assets themselves, your mindset. Because having the right assets is only half the battle. The other half is having the mental strength to not panic when everything's falling apart. See, crashes are terrifying. When you see your portfolio down 30%, when the news is full of disaster stories, when your neighbors are panicking, your instinct is to sell, to get out, to preserve what you have left. That's human nature. It's how we're wired. But it's also the worst possible thing you can do. Because when you sell during a crash, you lock in your losses. You turn temporary paper losses into permanent real losses. And you miss the recovery. The way you combat that instinct is by having confidence in your structure, by knowing you have protection. When your stocks are down, you look at your bonds and they're stable. You look at your cash and it's ready to deploy. You look at your businesses and they're still operating, still generating cash. That knowledge gives you peace. It keeps you from panicking. It lets you think clearly instead of emotionally. And that's when you can act. That's when you can buy when others are selling. That's when you make money. You know, I'm 95 years old now. I've lived through more crashes than most people have lived through years. And every single crash, people ask me the same question. Warren, how did you survive? How did you make money when everyone else lost? And my answer is always the same. I was prepared. I had the right assets. I had the right structure. These four assets, real businesses, bonds, moat businesses, And cash, they're not complicated, they're not secret. Anyone can build this structure, anyone can protect themselves, but most people don't. Most people chase returns. They want excitement. They put everything in the hot stock. They ignore bonds because they're boring. They never keep cash because they think it's wasting opportunity. And when the crash comes, they get destroyed. Don't be that person. Build your fortress. Get these 4 assets in place. Structure your portfolio for survival, not for maximum returns. Because here's what I've learned in 75 years of investing. Getting rich isn't about making the most money in the good years. It's about losing the least money in the bad years. Survive enough crashes and you'll get rich. It's that simple. So build your protection now, before the next crash, because it's coming. I promise you that. And when it does come, when everyone else is panicking and selling, you'll be calm, you'll be protected, you'll be ready to act. That's real wealth, not just having money, but having the structure to protect it, the wisdom to preserve it, the patience to grow it. 4 assets, real businesses, bonds, moat businesses, cash. Build them, maintain them, and you'll survive every crash that comes your way. Thank you.